Hey traders, this is Blake Morrow with Trader Summit, and I'm bringing on Mr. Jim Welsh because it's Friday, and he's here from Macro Tides. Well, actually, he's not from Well, you are from Macro Tides. You're from California, and you're here anyway. Good morning, Jim.
Yeah. You're stumbling, bumbling, and I'm not sure you're finding the end zone.
You know, the fact of the matter is, it's been a wild week this week, and it seems like I just talking about this week, and we had CPI and yesterday, Thursday's data with the U.S. weekly unemployment claims and retail sales. The market went on a rampage. It's Friday. We're giving some of that back. Why are we seeing this massive whipping around around in the summers? What's happening here?
Well, liquidity declines in the summertime. People are on vacation, and instead of being on Wall Street, they're in the Hamptons or somewhere else. And so I think on Wednesday, New York Stock Exchange volume was about a little over 500 million. I mean, I did a double take, and then I rechecked that number yesterday because average volume even during August has been around 850 million.
Wow.
So you have less liquidity, but we have markets that are incredibly focused on every little nugget of data that's coming out. And the emphasis on each piece of data is, I think, more than what it would normally be. So that combination of data coming out, surprising people, and then that against a backdrop of less liquidity just amplifies moves in a short period of time.
And Jim, I mean, I knew positioning had to been it yesterday on Thursday with the retail sales and the way the dollar moved, and that's not even it's like second tier data, and we got these huge explosive moves, and I have to imagine that there's so many people that have been calling for a recession and said that we're on the cusp of a recession. It's an election year, so the markets are going to come down, and and obviously that poor positioning probably contributed to some of that volatility. Would you agree with that?
Absolutely. I mean, 2 weeks ago when we were talking, the unemployment rate, it almost seems like it's only 2 weeks, but yeah, it was 2 weeks ago. The unemployment report came out. The unemployment rate ticked from 4.1 to 4.3. It triggered the Somme rule. Oh my God, we're going into a recession. The manufacturing report came out that week. And so you had this extreme, and 2 weeks before that, hey, everything's copacetic. We don't have to worry about the economy. So we've seen these huge shifts. And, when we talked 2 weeks ago, I said, this is an overreaction. The economy is not in a recession. I think slowing is going to continue, but this is a big overreaction. And then what has taken place is, as the data has then come in, where unemployment claims came down. Well, we talked about that 2-3 weeks ago, that there was a seasonal pattern that implied that we would see a decline in unemployment claims. And if it didn't happen, well, then that would be a cyclical message. So I just think a lot of things have come together, Blake. And the VIX, I'm going to show a chart. The VIX spiked up to 65. So historically, going back, I don't know, I think to 1990, because that's when the VIX was created, getting above 35, it's usually taken, I think, like 170 days to get back down to 17.6, which is the median reading. We did it in 7 days. So I think that just amplifies. A move to 65. Oh my God. Oh, never mind. We're back to, 15, 16 in 7 trading days. So it's all that is adding up together, which obviously we all want volatility. But when markets knee-jerk in response to an economic report, where boom, in seconds, that's a really difficult environment, because if you're off sides, man, you feel like you're way off sides very quickly.
Yeah, that's sure is the way it felt on Thursday. All right, well, Jim, let's talk about you did bring charts, so let's go into them and just start there.
Well, one thing we got to mention though before, Blake, is next week is Jackson Hole. Powell will be giving a speech next week. And obviously market participants are keenly awaiting what he's going to say. 2 years ago, His speech lasted 8 minutes, and it was kind of like, we're not kidding about fighting inflation, and we're going to be raising rates aggressively. And the market's like, oh my God, we're not going to see anything like that next Friday. If you want to go read his transcript from the July 31st FOMC meeting, he comes out, gives a statement. He's going to talk about the great progress they've made in terms of inflation coming down, that the risks are balanced now because inflation is down and they're watching the unemployment rate tick up. People are going to be hoping and praying that he'll give some kind of a clue or hint about, gee, is the Fed going to do 50 basis points at the September meeting? That is absolutely not going to happen. It's going to be a regurgitation, I think, of things he said. But, markets will crawl to a stop when just before he starts giving that speech, and people have a few moments to read through it.
Well, Jim, and I think the time is slated for 10 a.m. Eastern, just to make sure that I think it's his normal spot, or the Fed chair. So, it'll be there. All right. Well, thank you for that update. Let's talk about the CPI this week. So, I mean, is Fed Chair Powell going to put up the flag at Jackson Hole and say mission accomplished?
Mission accomplished?
Yeah.
No. He's going to be talking about they're dedicated, they're going to get inflation down to 2% and so forth, heartened by the progress. What's interesting is in June of last year, the headline CPI ticked down to 3%. So we've gone 13 months and it's down 0.1%. And that downtick to 2.9, Blake, happened because the monthly increase in July was 0.15. And so they rounded the number down to 2.9. If it had been up 0.16 in July, it would have stayed at 3. All right. So they're talking about markets being so, oh my God, so clearly there's progress being made. The progress has slowed materially, but this is what the Fed wants to see. At the same time, I think when they have their conversation, there's a group of Fed members that want to be patient and proceed cautiously. Powell has endeavored and succeeded, I think, for the most part, of getting a consensus. So the idea that they'll go 50 basis points, I think, is the probability that is extremely low, unless we get the employment report for August and it's we created 11,000 jobs. Okay, so my point is, I think knowing the dynamics inside the FOMC meeting room, 25 basis points is where the hawks are going to be comfortable. Then the debate comes down to, well, we're going to do 25 every meeting, or are we going to be skipping meetings and so forth? So I think that's where their mindset is going to be. But the markets are, wanting to believe that the Fed could go 50 basis points. I just think that's extremely unlikely.
Yeah. Okay. Well, it seems like it at this point, and I mean, I know expectations are shifting quite rapidly, but the next chart you brought up, Jim, is core or CPI core services. Explain to us this chart.
Yeah. Well, first of all, you have to look at the composition. Often I talk about how goods make up about less than 15% of GDP. Almost 80% is services. Well, in the CPI, it's 77% of the composition of the CPI is services, 23%. So what we can see is you had this huge jump in goods prices from January of 21 into January of 22. They've come down and they've actually been deflating. The price of some goods have actually been falling. In the meantime, we've seen service inflation come down, but again, over the last year, very, very gradual in terms of the progress. So again, as long as the economy looks like it's okay, the Fed is going to look at this kind of data and say, all right, there's no need for us to rush. We just have to be more patient for the service side of the equation to come into better balance.
All right. Well, moving past the CPI data, let's talk a little bit about retail sales. I mean, this is that's a big green wick you see.
Yes. And up 1%, very headline grabbing, right? But as usual, it's kind of like everybody overreacted with the unemployment report or the employment report. All right. Oh my God. and now I think in some respects, they overreacted to this data, in part because in in June, you might remember there was a software hack. Car dealerships all throughout the country effectively could not transact business. Now they did it by hand and all the rest of it, but that really hurt sales. And in the month of July, auto sales and parts rebounded by 3.6%. That's a huge increase for any month. And so if you back out that component, retail sales were still decent, up 0.4, but that's a lot less than 1%. And then, oh, by the way, we revised June down from showing 0 to a minus 0.2. So when you look at all this stuff, the headline certainly was way stronger than what the underlying details implied.
Yeah.
But people are so hungry for data points that 1%, boom, let's hit the buy button. You know, they're not going to bother to read the details or digest that. And that's kind of where we are, just like they hit the
maybe
button 2 weeks ago.
Yeah, I was going to say maybe they did, but it's a day later. It's like everybody, sits back and goes, "Oh, wait a second," and here it is, Friday, and maybe that contributes to a little bit of the selling or reversal we've seen today.
Again, for me, it's just more evidence that the economy is still okay. As I said 2 weeks, not in a recession, but I think this gradual slowing is still unfolding. But 0.4% was a decent number. But again, the headline, is what got the reaction function to get triggered.
Sure. Well, speaking of headlines, the next chart you brought is the VIX, and I know you just talked about it, but I mean, I had heard your statement earlier. There was somebody else that basically said, whenever we get these big moves in VIX, it's usually predicated by is it predicated? Is that the word I'm looking for? With a recession, and but the reversal happened so fast.
Yeah, that's not entirely true, because in 1997 there wasn't a recession. There were some issues in Hong Kong in the fall of that year. 1998, we didn't have a recession. You had long-term capital management and Russia defaulting on bonds, no recession. But in 2001, yes, very, very shallow recession. 2002, you can see it. 2008, obviously, we know what that is. 2010 was kind of the flash crash. 2011 was the European problem where, Mario Draghi said, whatever it takes. But you can see 2015, 18, there were some sharp breaks and spikes, but they didn't get up to 65 in 2015 and 18. So you have tens of billions of dollars that have flowed into some mutual funds and ETFs, Blake, that their whole business model is shorting the VIX. Anytime there's a spike, they short it. There's a lot of money in play. Yeah. And so that in part, I think, is why you saw the spike up to 65, because they got caught wrong-footed. I mean, we went from don't worry about the economy to, oh my God, the sky's falling in 72 hours. So, but it just underscores the whiplash that we've seen over the last 2 weeks. And the VIX kind of is expressing that up to from 15 to 65 back down to 15.
Yeah.
That's unbelievable in 8 or 9 trading sessions.
Very, very fast moves, Jim. Very, very fast moves. Okay. The next chart is the S&P. Now, I want to talk to you a little bit about the S&P, because a couple weeks back, you had mentioned, and I'm trying to even think about what you talked about last week, but I do recall a couple of weeks back, you're like, we could go to all-time highs.
Yes.
Is that still possible?
I think so. I mean, in last week, I was more cautious. I kind of said, hey, there's options here based on the depth of that decline. Originally, I was looking for a decline. I think it was 52.87 or something, where the two legs would be equal, A, B, C. I talked about the decline from 56.70 to 53.91. Looked like 3 waves, then 3 waves up to 55.66. All we needed was a C wave. And, it got far more stretched. And so the rebound that we saw off at 51.19 looked like an ABC. And that implied that potentially, given the intensity of that decline, we had to be open to the idea that we were going down again to below 51.19. I also said, if we overlap 53.91, then new highs are on the table again. And obviously, we didn't go down. We overlapped 53.91. And the reason being is if we were in the middle of a 5-wave decline, you're really not supposed to. I mean, to have an overlap of wave 1 down. And that was where the low of 53.91 was.
Yeah.
And so therefore, getting above that negated the bearish potential, I think, significantly, and increased the probability that we're going to a new all-time high. And in my August 5th week, yes.
Oh, no, I got a question for you as soon as we're done. Go ahead.
Okay, no, my August 5th, and I've talked about this, you and I, that you could have a window created where, people worried about the economy going into recession. Oh, it's not going into recession, and the Fed's going to be cutting rates. You have this window where the markets could respond very favorably to that. It's like the best of both worlds. No recession, and the Fed's going to be cutting rates anyway. And that would open the door to a new high. And so, to me, the fact, as the chart explains, I think the odds are back on the table. The S&P is going to go to a new all-time high. And once it gets up there, we'll decide what's going to happen next, or at least guess intelligently, hopefully.
So, can I? So,
yes, please. It's about time. I mean, God, I gave you like 3 seconds.
Okay. All right. So this has been a sharp rally, obviously. I personally believe that we are in process of building a top in the market, therefore creating a lower high, which could have been at this, this Thursday, this week. Could this be a bear market rally? Just a very sharp, in your face, because they're pretty damn convincing.
Yeah.
So
yeah. Again, everything I talk about is I like to believe it's an educated guess. We're dealing with probabilities, as you have talked about, which anybody who's been involved with markets knows that's what we're dealing with. So is it possible? Yes. I think we are building a top. I think that top could include, as I have it labeled, from the low last April. Got 1, 2, 3, the spike down to, August 5th low is 4, and now we're in wave 5. I think that top can include one more all-time high. It can get up towards 5,800. 2 legs being equal would get you to 5,835, I believe. At that all said, I still think the economy is working its way where we're going to have a recession. We're not there yet. It's taking longer because of a lot of different factors, many we've already discussed over the last few months. So I'm in the same camp with you, Blake, in terms of we're building a top. Now, I will note the advanced decline line made another new high yesterday. So very often, going back to 1928 and 29, most important highs have been attended by a high, a pullback, S&P goes up to a higher high, but the AD line makes a lower high. That's what happened in 2007, which also was the last time we had a 17-year cycle high. And so that's one of the pieces that I continue to think that to have more confidence and conviction that the market is topping, I would like to see that advanced decline line negative divergence develop. And it hasn't happened yet. It doesn't mean you can't, have a big decline.
Yeah.
But probability-wise, divergences with the AD line have been really, really important.
Jim, I'm going to have to ask, because I know for our listeners, they're probably like, wait, 17-year cycle, what are you talking about? Maybe in the next week you could
We'll review that.
unearth that chart again. Because I think it's
Yeah.
pretty important based on your framework on what you're trying to, how you're looking at the markets. I think it's important for
Yeah.
viewers who
Yeah.
haven't seen it to
Yeah.
see it.
Yeah. I will do that.
Okay, great. All right, well, let's move along and let's talk about the yen, because last week you were talking about the yen still has more to go, but the yen has squeezed or squeezed. It's pulled back even further than I thought it was going to this week, and we hit a 38% retracement and actually hit it yesterday,
Right.
and allowed for some of us to step in fresh with some new positions. But are you still seeing that the yen has some potential here? I mean, there's a lot
Yeah.
of talk going on, a lot of
Yeah.
things.
Well, I mean, there's the unknowable. How much of the yen carry trade has been unwound?
Sure.
And I just think when I look at it, say, well, the Bank of Japan had negative yields from 2016 through 2023. That's 8 years. Is it going to be unwound in 5 weeks? I don't know. That doesn't seem very likely to me. The pattern implies that, another move up to a higher high is called for. Momentum, the 5-day exponential, the red line is above the 13. Until you get down to where I have that number one, just, that's like, okay, that would overlap maybe wave one. That would start to call into question.
Yeah.
But I just think there was some data came out, and I can't remember precisely, on the Japan economy, and it was stronger than expected. So, is the Bank of Japan going to raise rates if things calm down? And I think the answer to that is yes. They said, well, we're not going to do it when markets are unstable. Okay, that makes sense. But stability is being restored. So I still think at least a decent retracement is likely, Blake. Because that's a pretty sharp break from 71 down to 67. So getting above that 0.688, would be another indication that, okay, you're on your way. So now the thing is, this wave 4 that the yen has been in, it could take weeks. In other words, we get a rebound and then there's more sideways and a pullback, before it really goes again. But that, I just think the odds are, given 8 years of negative rates, that the yen carry trade has not been completely unwound. And now that there's been some stability, my guess would be is some people put it right back on.
Yeah. Oh, I believe
Such a
that's been
huge
happening.
trade for so long,
Yeah.
a winning trade for so long. They're going to feel like, well, the Bank of Japan just told us they're not going to be hiking anytime soon, so we don't have to worry about that. Yeah, that's probably true,
And
So,
considering the fact that equity markets are not too far from all-time highs, you would imagine that a lot of those carry trades are being put back on as
at
we
least
speak.
somewhat.
Yeah.
Yeah,
Sure.
which again argues that it's not completely unwound. But again, the timing of this is the question mark.
All right. Well, the next chart you brought is the dollar. So how are you viewing the dollar here?
I still think the dollar is going to rebound up towards that 104 level, that middle lower red trend line. I'm
Yeah.
just assuming that, okay, we broke down from that at some point in time, it's going to rally back up and tag the underside or maybe get above it slightly. So that's my guess that's what's happening. The RSI down near 35, all tilt the scales for additional rebound. So that spike, that rebound off of 102.16 to whatever that high was, I think it rallied about 140 basis points.
Yeah.
Then it pulled back. So in a sense, A, B, pop above that for a wave C, and it gets you up to 103.60 towards that 104.
So you think we're going to bounce to 104 and then roll back over?
Then I think it goes down to, yeah, no, I think the U.S. economy is going to continue to show signs of slowing. The data is very uneven. The emotional aspects have been ridiculous extremes. But I just think if you look at the data, it's very gradual. But the trend is unmistakable.
Well, maybe over the next couple of weeks, speaking of the dollar and the rest of the markets, we should probably start having a conversation about what it looks like in a Trump presidency or a Harris presidency, and what those different outcomes might look like. That's just maybe some food for thought, Jim. And if you all want to see Jim's response to that, jump in the comments down below and ask him, and maybe he'll put something together for you. Sorry, Jim, just gave you some extra work. All right, so
I know.
gold.
I just feel like, in the current environment, in my August letter, I made a comment, and maybe I'll actually show this quote, because to me, it was by I can't I remember her last name, but anyway, it's just about lying, how political people lie, and at some point in time, it reaches a threshold where it's difficult to discern what's the truth and what isn't. And once you reach that threshold, you basically can lead a populace and people around by the nose, because they have no idea what's the truth anymore. I think we're there, personally.
Yeah.
Okay. And to me, it's frightening, because it's like there is no anchor, and it's just, I mean, the last month has been incredible to see what's happened. My assumption is that Harris is going to win, for a lot of reasons, in part because of Trump being Trump. But we can talk about more later some other time.
Yeah. Again, I think what we're going to have to do is we're going to have to really think about, like, what are the outcomes, whatever we believe, whether it's this side or that side, who wins, who doesn't. More importantly, is what's going to be the market reaction. Maybe one of the reactions would be that gold just continues to go up, because we are at all-time highs again today.
We hit it, and you see that trend line connecting a number of highs.
Yep.
We got up to it, we tagged it, then we pulled back. My assumption is it's going to break through. I mean, if you think about it, since April, gold has been just on balance, going kind of sideways with a slight upward tilt, but it looks to me like it should follow through this time. And, that would imply a target up around 2,600, given the width of the triangle. That, that's my guess, but this has been very frustrating. And again, this is considered, if we get this pop, that'd be wave 5, which then means you get this pop, and then there's going to be another pullback. And so, to me, I would be a seller into this pop, because for traders, because I think that what will follow will be another pullback.
All right. Well, it seems like every time you chase it right into the highs, and it has it struggles with that resistance. So
yeah.
All right. So, last but not least, you got your treasuries. So let's what are we looking at here?
I just think the chart pattern is interesting. So we can see how from the high last April, the 30-year has been in a zigzag lower within a channel. And then with the unemployment report and Japan, you can see it just crashed through the lower line, snapped back up when the claims number came in better than expected last Thursday, and then has been holding it. Then yesterday on the retail sales, ticked that line again and then came down. So to me, as long as the 30-year stays below that lower trend line, which comes in around 428, it's like, okay, that implies that yields should continue to fall. And even if it gets back into the channel, Blake, it doesn't rule out that yields continue to fall. It just means, okay, you're going to get a deeper retracement, obviously, here. Again, my assumption is the economy is going to continue to slow. And at some point in time, as the Fed starts to cut rates, Treasury bonds are going to benefit.
All right.
And,
well, the
30-year should drop below the 394 level, which was the low last December.
Okay, and that means bonds will continue to catch a bid, and
higher.
A lot of people don't believe that didn't believe that's even possible. So here we are, right?
Yeah, and they still don't, because supply is an issue, and I agree with the supply argument. It just comes down to timing. I just think when the economy slows enough, goes into recession, and all of a sudden supply and the deficit goes from 1.7 trillion to closer to 3 trillion, I think you could get a combination where the Fed's cutting rates, but the amount of supply just overwhelms the market. And ultimately, Treasury yields exceed the highs from last October. I just think we're in this period where if the economy slows, goes into a recession, on the front end of that, you get a big drop in yields. Because that's always what's happened, and muscle memory being what it is, insurance companies, mutual funds will be aggressive buyers of treasuries if they really start to believe that the economy is in fact headed for a recession.
Well, Jim, I want to thank you for spending your time with us, guiding us each and every week. And if you guys and gals enjoy Jim and our time together, make sure you jump down in the comments below. Make sure you give him a thumbs up. Subscribe to this channel so you don't miss any. Remember, it's free to subscribe to this channel on YouTube and hit the bell icon so you're notified every time a new video comes out. I had somebody respond last week. I know you were enjoying a couple of days away, but it missed my editing window and it came out on Sunday versus Saturday. And I actually got an email saying, "Hey, where's my damn video?" So
well, that person needs to get a life, right?
no, it's thank you, Al, for listening in. And
absolutely.
And you know, if you want to get a hold of Jim, what's the best way to get a hold of you?
Macrotides.com. Send me an email, jimwelshmacro@gmail.com.
Great. All right, Jim, thank you so much for spending your time with us this week, as you do every week. And if you all enjoy them, make sure you give them a thumbs up. So we'll talk to you next Friday.
You got it, Blake. Thanks so much.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.